A single painting just cost $47 million to insure for 6 months. Nobody's stupid here, follow the money. Most people think art insurance is straightforward. You own something valuable, you pay a percentage annually. The insurer covers theft or damage. Clean transaction. Except that's not how it works at all. High-stakes art insurance isn't really insurance. It's a three-dimensional chess game played by collectors, museums, auction houses, and underwriters who have engineered a system where the real profit lies in the gap between declared value and actual risk. Start with the obvious problem: how do you price the unpriced? A Rembrandt doesn't have a stark ticker. There's no secondary market data refreshing hourly, so insurers don't actually assess value independently. They accept whatever the owner claims. That's not negligence, that's the business model. A collector walks in, says the painting is worth $50 million, and the underwriter nods. Why? Because nobody in this story is stupid. Look at what they were paid to see. The insurer's real leverage comes later. They charge based on loan-outs, exhibition status, storage location, and something called agreed value. That last term is doing heavy lifting. An agreed value policy locks in a price both parties accept, usually inflated from market rate because the owner benefits from the higher number. It's tax deductible when donated. It justifies the acquisition price to creditors, and it protects the insurer's bottom line because they're betting the painting never actually needs to be replaced. Here's where the mechanism reveals itself. Total loss claims on major artworks are vanishingly rare. A stolen Vermeer stays stolen. A burned Pollock stays burned. You can't manufacture a replacement in a factory. So the insurer is essentially betting that the painting won't be destroyed. And if it is, they'll litigate the owner's claim for years, citing environmental negligence or undisclosed prior damage. Real economics emerge when you zoom out. A major collector might insure a $100 million portfolio for roughly $500,000 annually. That's 0.5%. Sounds reasonable until you realize they're only claiming that premium because the insurer demands it. The actual expected payout is closer to zero. The insurer knows it. The owner knows it. Both parties are essentially paying for optionality and legal protection. Museums operate differently. They self-insure, which means they assume the risk themselves rather than paying premiums. Why? Because institutional art almost never moves. It hangs on the same wall for decades. The actuarial risk is so low that paying an external insurer becomes pure waste. They set aside reserves instead. The insurer gets nothing. The museum keeps the capital. But here's the wrinkle that changes everything: temporary exhibitions. The moment a painting leaves the vault for a traveling show, the insurance premium spikes. Not because the risk is actually much higher, modern climate-controlled transport is genuinely safe, but because the underwriter now has exposure they can't predict. The painting's in transit. It's in a different building. Liability questions multiply. This is where auction houses enter the game. Sotheby's, Christie's, they negotiate blanket policies that cover hundreds of pieces simultaneously. They leverage scale. A single painting might cost $50,000 to insure for 6 months on the open market. But bundled with 200 others, the per-unit cost drops to $8,000. The insurer accepts the lower rate because volume guarantees premium flow, and because auction houses have reputation capital. They won't claim on something questionable. Fraud happens, though, quietly. A collector insures a painting at $30 million. Years later, they claim restoration damage that diminishes value to $15 million and file a partial claim. The insurer investigates. Sometimes they pay. Sometimes they fight. The incentive structures are perfectly aligned for disputes because both sides have been lying about value from the start. The owner inflated it. The insurer accepted the inflation knowing it was inflated. The real role of art insurance, then, isn't protection. It's legitimacy. It's a piece of paper that says the value is official. It's collateral. It's tax documentation. It's proof of ownership in a market where provenance is everything and documentation is currency. The insurance policy is almost incidental to the transaction. This machinery exists because art sits at the intersection of 3 irreconcilable needs. It must be genuinely valuable for tax and estate purposes, genuinely irreplaceable, so insurance can't actually fix the problem, and genuinely mobile, so it can travel for exhibitions and sales. No other asset class has all 3 properties, so the system evolved to manage the contradiction by making insurance less about indemnification and more about consensus. When a museum loans a painting to another institution, both insurers coordinate. The sending museum's insurer might cover the first leg of transport. The receiving institution's insurer takes over at the destination. It's a relay system designed so nobody holds the full risk. That distribution is the actual product being sold, not coverage, but risk fragmentation across a network of institutions that trust each other, because they've been doing this for centuries. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how wealth actually works, how value gets manufactured, documented, and moved through systems designed to obscure exactly that, subscribe so you don't miss the next one. This video is for educational and informational purposes only and is not financial advice. Always do your own research.